Hey there, folks. Welcome to Chart This with Dave Keller. It's Tuesday, December 17th, and I'm your host, Dave Keller, founder of Market Misbehavior, coming to you from a kind of big time rainy and windy Redmond, Washington. I hope you guys are all doing well, and I'm here to announce it has happened. The Hindenburg Omen finally registering two sell signals within 1 month. We've sort of sounded this partial alarm a number of times so far in 2024. I think 3 other times. We had the initial warning sign, but then part of the omen to be completed is you need a second independent signal within a couple of weeks, within 4 weeks, really, right? That finally happened yesterday. Yesterday, you had enough stocks making new 52-week highs and enough making new 52-week lows, combined with the McClellan oscillator, combined with the overall trend measurement of the NYSE Composite Index. It has happened, which means all of a sudden, December 2024 is starting to look very similar in terms of the technical conditions as part of the Hindenburg Omen to other major topping points. We're going to spend a little time here on the show digging into the Hindenburg Omen, just confirming what it is that we saw and what this signal might mean. Some of the tools we will use to gauge a potential pullback if and when it does happen going into January. Exciting. And I don't mean to be too happy that the Hindenburg Omen is signal. It's usually not a great thing for the markets, but it's always interesting because it doesn't happen that often. I mean, every couple of years, you maybe get one of these signals. So this is one of those that I found paying attention to it usually has been a pretty good thing. We'll get to that chart and many others as we go through the show. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you so much tuning in wherever you see this. If you're watching the live stream, I can see comments you're making on any of those platforms. If you have questions as I'm going through the market recap, going through the charts, going through the heat map, just put them in the comment section, whatever platform you're on. I'll try to take a question or two at the end of the show. And then this Friday, we're planning an all mailbag episode, and we'll pick some of the questions that we've received during the show this week that we weren't able to get it to. So please ask your questions as they come up. Let's look at the markets and how they played out here. The S&P finishing the day down 0.4%. That's around 60.50 for the close of the S&P. The Nasdaq Composite almost identical, about 1/3% lower. The Dow actually the worst performer, which is kind of a consistent pattern that we've seen. But usually it's been the Nasdaq up, the Dow down. Now it's kind of an everything down kind of day. Not an end of the world down, let's be clear. The S&P is only down 0.4%. But the mid-cap and small-cap indexes down a little bit further. The S&P 600 small-cap index down 1.4%. That is the worst performer on the front page here. The VIX pushed higher by over a full VIX point. We are above 15 now. And for me, the 15 level is just that back of the envelope. You know, are we in a low volatility environment that I shouldn't be worried about, or something maybe different? And we are now in the something maybe different category, having pushed back above 15. Now, there's been a lot of chop and noise around this level earlier and through the course of this year. So again, not necessarily the end of the world, but when you have a market that's been as strong as we've seen in 2024, at some point that trend is going to change, right? It's not going to keep going with this pace forever, right? And at some point it changes. So what I've been trained to do is look for signs of that change manifesting, right? Where can I see the evidence that that change is happening? Things that I would be looking for would be deterioration in market breadth indicators, which we've seen. A spike in volatility. I don't know if I would call this a spike in volatility yet. The VIX is still in the mid-teens, but it's pushed above 15, which sort of that initial warning sign. That's the alert that I have set, which fired off this morning, which said we might be no longer in a low volatility environment. Stocks just flat out not holding support levels. And we're going to highlight some of the charts where that's kind of happening, like NVDA, like T-Mobile. These are stocks that instead of holding previous support levels are actually breaking down a little bit. So while the Teslas of the world still are in great shape, there are other stocks that are doing very different things. And that is really what is causing the Hindenburg Omen, as we'll get to in a couple minutes, is certainly part of. All right, looking at the interest rate environment, you can see, honestly, no significant change from yesterday. 10-year, 5-year, 30-year points all just slightly lower, but not by a ton. The 10-year point still right around 4.4%. Long bond yield just below 4.6%. 5-year yield right around 4.25%, which is pretty much where it was yesterday. So what's happening is the short end of the curve kind of sticking where it's at. The long end coming down just slightly. We're sort of waiting. We're treading water, and really it's more flat than anything. preparing for the Fed meeting, which is today and tomorrow. Tomorrow will be Fed Day. We will do an episode of the show. We'll probably spend most of the time just talking about the Fed and expectations, and really trying to unpack as much as we can about expectations for further rate cuts going into the beginning of 2025. So it should be a good show tomorrow to tune into as well, to debrief on the latest Fed meeting. The dollar, really no change from yesterday, to be honest with you. Looking at the commodity space, generally more down than up. Gold down slightly, about 0.4%. Silver prices about steady from yesterday. Crude oil prices down a little bit. Natural gas, really the only thing that was up in any meaningful way using those commodity ETFs that we're tracking there. Looking at cryptocurrencies, again, Bitcoin continued to show strength. Yesterday, we had spiked up toward the 108,000 level. Today, we did briefly break above 108,000. Currently down around 106,350 as we go live with the show here, and that's up slightly from yesterday. But generally the long-term charts of Bitcoin looking pretty constructive here. Now, Ether, there's a bit of a divergence, to be honest with you. While Bitcoin is sort of testing new all-time highs, kind of feeling like it's gaining ground, Ether prices kind of staying a little more measured. Ether currently down about 1.33%, still below 4,000, which is sort of that big round number you want to see it get above. We did push above there in the last 24 hours, but kind of rotating back below. Mixed results for the rest of the top 10 coins tracked on the stock charts platform. Through the course of the day, the sector movements got less and less awesome. Earlier in the day, there were a couple sectors in the green. By the end of the day, only one, and it's the XLY, which is boosted by stocks like Tesla up 3% on a day like today when most things felt like they were more down. So the XLY, the only one of the S&P sectors up. So 1 out of 11 in the green. Everything else was down, but second and third on the leaderboard, healthcare, then consumer staples, then utilities, then real estate. There's pretty defensive sectors in there for sure. Those are kind of that's the defensive cohort of the 11 S&P sectors, all represented there in the top half of the leaderboard. On the downside, industrials only down about 0.9%, followed by communication services, energy, financials, all down about 0.7% today. No change yet in our market trend model. And I will tell you just a preview of when we look at the Hindenburg Omen chart in a little bit. What I would tell you is that when I do see a confirmed Hindenburg Omen, which we now have for the first time since the end of 2021, it's been 3 years. I have learned not to just assume the market's going lower. You're welcome to make that assumption. I'm not ready. What it tells me is that the conditions are ripe for a pretty significant pullback. Now I need the evidence that the charts would provide. I need the S&P to be breaking down. I need the Qs to be breaking down. I need to see the short-term models rotating lower, which is what would logically happen if this Hindenburg Omen is basically telling you the conditions are ready and that we're going to have the sell-off. I need to see those initial signs of that rotation. We're seeing it in other measures like momentum, like breadth, all sort of rolling over, but the benchmarks are still strong as defined by my market trend model. So the mid-cap and small cap market trend models do appear that they could be turning lower. However, I would be looking for the S&P's market trend model to be turning lower. The short-term model, for now, not quite happening. There's a lot of game left between now and Friday at 4 p.m. Eastern, so we'll see what happens. But that's what I'd be looking for. And I don't update my model until Friday at the close. So those are, that's the observations as of last Friday's close. All right, looking at the Magnificent Seven and Friends, these leading growth names, this has been the strength of the market, right? So the reason why the S&P and the Nasdaq are so strong, despite the fact that breadth has been weaker, as we've covered, I think, pretty well, is the fact that the biggest names are still doing pretty well. That may be starting to change, at least today. The Magnificent Seven looks kind of like the market. You have a couple stocks that are up, right? Tesla up almost 4%. That's, by far one of the top performers in the S&P. You have Apple and Microsoft both up, 0.5% to 1%. That's pretty good. But everything else in this group was down. NVDA breaking below 132, which was sort of my line in the sand, the lower end of that consolidation pattern. Currently just above 130. That's down another 1.2% today. Amazon and Meta both down about 0.75%. So again, these charts are still good, right? The chart of Meta is still a great chart, and on a relative basis, an exceptionally strong chart. But days like today, if strung together, and if you see a pattern of these kind of distribution days, that's where trends can change, right? So overall, that I think obviously, as always, a key group of stocks to watch for now. Some of them holding in there quite well. All right, let's go to the market carpet, a heat map style visualization. And again, I can't see a number of questions coming in related to the Hindenburg Omen, related to the the VIX spiking, the Santa Claus rally. I will get to as many of those as I can here at the end of the show. Keep them coming. Anything we don't get to, we'll put in the mailbag for sure. And on a Friday, and we have some time, a little more time to spend on some of those, we will do our best. All right, looking at the heat map, question one, what are your general takeaways? My general observation, this is a distribution day, not heavy, right? So you don't see a bunch of things in bright red. And I will never, ever, ever forget in 2008 and 2009, which is when I left New York, moved up to Boston and joined Fidelity Investments. I'm standing around in the offices of some of my analysts as we're looking at the markets on our Bloomberg terminals. And I vividly remember just looking at the S&P 500, just all red. I mean, just bright red. I mean, things down 5-10%. And I remember sitting there for like 20 minutes, heavy 20 minutes, and no one said a word on one of these days. We're just kind of looking around and just watching all these things go down and just trying to make sense of what was happening. Because this is as the ramifications of the financial crisis were still unclear. We were just watching a lot of charts get absolutely butchered on an intraday basis. And so it's not that bad, right? We're not in end of the world 2008, 2009 kind of bad, but this isn't a great day. And you can see a lot of sort of neutral and in the lighter reddish color, which just means they're not up. They're probably more down than up. So, generally speaking, that would be my observation. I'm particularly noticing in some of the cyclical sectors like financials and industrials and materials and energy. These are sectors that just don't look particularly good today. But I think what's most striking for me is what's happened recently in the market is these sectors have not been particularly great anyways, right? Industrials and financials have not been thriving. Energy has not been a particularly great place. So this doesn't look that different from an average day I've seen. But what is different are all the growth sectors, which are now looking a lot more like those, right? And that's, as we mentioned, that's the danger of what we've observed in Q4 post-election, right? Is the markets have been going up because the benchmarks have been driven higher by the biggest names still doing quite well. If the biggest names are going to be down 0.5%, 1% more than that on a continued basis, what's left to take on the leadership role and push the markets higher? I'm not seeing a lot of that right now. And the biggest concentrations of green I'm seeing are in places like consumer areas, probably more than anything, right? Maybe some healthcare, which is really a modeled kind of mix, but some of the pharmaceuticals like Pfizer, Bristol Myers, right? These are the only things that are kind of doing well. So I would say the market carpet's certainly more of a less than optimistic tone on this particular day. In terms of the big dogs, the big names, it's really mixed today, and it's not been mixed in a while. These names have, generally speaking, been up a lot. So while Alphabet and Meta and Amazon are not far off of all-time highs, and to be clear, I think the trend is still quite positive on all of those charts that I just mentioned. But for today's observation, what did we learn incrementally? I learned that these can also go down. And so the question is, do they go down enough that it starts to be concerning? And that's why the chart of NVIDIA, for me, is in a big red flag moment, because it's not holding a recent support level. And some others, which I grabbed to review with you. In terms of other things, I think I've covered this pretty well. I mean, I would just highlight on a day like today, when most things are down, I would focus on things that are not down, focus on things that are actually rallying when the market is going lower. And while those don't guarantee that something like Win is the best chart ever, it's going up when everything else is going down. There might be something there, something I want to review. Maybe I want to update the levels that I'm paying attention to and see if there could be an opportunity. With Win in particular, I think there's still a little more to prove. 95 would be the level I'd want to see that get above. But overall, I'm focusing on some of these areas of green. The problem I have with these, if you look at anything that's in green, they're not great charts, right? It's like solar stocks and renewable energy, which have been absolute, horrible charts in 2024. Fox maybe is an outlier of a stock that's just in an uptrend, doesn't seem to have caught the memo that things are going to go down this week, and they're just kind of pounding higher. But others, right? Pfizer coming out of a very beaten down level, Bristol Myers, which has recently pulled back. So a bit of mean reversion with some of those groups that I mentioned for sure. All right, we continue on looking at the chart review. We're going to look at a daily chart of the S&P and then get a little bit into the Hindenburg Omen. I've mentioned it a number of times, and I usually kind of, do a quick hit on the Hindenburg Omen. I'm going to dig a little bit deeper, take a little more time because it doesn't happen often. Every couple of years, you get one of these signals. I might actually do an additional video on this later this week just to reinforce the message and talk about some key levels. But these will be some of my initial reactions here today. So the S&P on a daily basis clearly still going up, right? And to be clear, when I sort of talk about, boy, this is a horrible day or this is a great day, we have to remember that's just observing one day. The real benefit to what you do by looking at charts is to not get so sucked into one day's movements, right? When I'm looking at the market carpet, I'm not managing a portfolio based on that heat map, right? I'm updating the thinking that I've done over the weekend. That's when I do the bulk of my sort of, all right, where am I positioned? What do I want to be doing? How do I want to be thinking about things? That's really for me as part of my weekly process. When I think about how I'm allocated, when I think about making changes to the portfolio or something, that's really done during a quiet period when I can take a few moments to think. Day to day with this show, what I'm doing is incrementally updating the evidence that I've gathered into last weekend, which is the bulk of my kind of big picture thinking process. So, what's changed? Not a ton, right? The S&P chart doesn't look a whole lot different than it did yesterday. We're down today while we were up yesterday, but overall, we're pretty much exactly where we closed on Friday, which is also exactly where we closed on Thursday, which is also almost exactly where we closed on Tuesday of last week. And also the first trading day and second trading day of December, we've all closed almost exactly at 60.50 today. So the market over the last 2.5 weeks has really gone nowhere. Not super surprised by that, given the fact that we have the Fed meeting this week, today and tomorrow. Tomorrow is when we get the Fed announcement, 2 p.m. Eastern, press conference at 2:30. I think that's going to be the most important thing. Wouldn't anticipate anything other than a 25 basis point cut. I would anticipate a lot of questions from reporters in the room with Chair Powell about what exactly they're thinking about further rate cuts, given the fact that the last inflation reading was a little bit higher than expected, given a lot of uncertainty and given the fact that the market just had an amazing run in 2024. I think it's making a lot of investors sitting on probably a lot of paper gains, rightfully a bit concerned about the sustainability of those gains. And again, seeing the signs that I'm seeing elsewhere with things like the Hindenburg Omen definitely doesn't have me, feeling like you want to be complacent here, just kind of ignoring what's happening. But for now, the S&P basically holding steady since Thanksgiving. The S&P still above an ascending 50-day moving average. That's good. Still above my line in the sand at 58.50. So I don't see a cause to be concerned about any distribution just yet. Let's get to the reason why I'm anticipating, though, that there could be some of that. The Hindenburg Omen was created by this gentleman named Jim Mieka, and I had breakfast with Tom McClellan, who first, I remember asking him years ago about the Hindenburg Omen because I think he'd written an article about it. And he gave me like the quick backstory. I wish I would have taken better notes. And I have to, next time I connect with Tom, I'll ask him to recount as much as he knows about it. He's kind of a good financial market historian about things like that. But it was basically a strategist who, looked at, did a deep dive on major market tops. And this was done decades ago, where he went and looked at, a number of key tops and basically tried to find consistent patterns. What tends to happen just before the market crashes? And that's why it's named the Hindenburg Omen, after the famous Hindenburg accident. And what he found were basically a couple different things. And I will tell you, having reviewed how other and different platforms treat the Hindenburg Omen, there's a bit of wiggle room in terms of the specifics that different platforms would be looking for, and even different analysts. But I'll tell you the version that I have kind of been using that I'm pretty comfortable with. You need the market in an uptrend. You measure that by the New York Composite Index being higher than it was 50 days ago. And that you can do that by doing a simple rate of change calculation above zero. That's the black line that you see here. The gray line is the New York Composite Index, the raw data. And then this is a 50-day rate of change. So it's still just slightly above where it was 50 days ago. So that's good. Second thing, you need at least 2.5% of the New York Stock Exchange listings to make a new 52-week high, and at least 2.5% making a new 52-week low on the same day. And that was basically a sign of indecision, right? Things going up and things going down at the same time. I would have intuitively thought a bunch of things going down would have been the better signal. And there is something called the Titanic syndrome, which tracks that. But this is in Jim's work, he found it was a little of both. You still had stocks usually making new highs, kind of the Teslas of the world, the Broadcoms, but you also had stocks in clear downtrends, making new 52-week lows. And you had both which often happened at a major top. So that's question 2, which we finally just got on Thursday. On Monday, yesterday's session. Finally, the McClellan oscillator, which is a measure of short-term breadth, needs to go below 0, telling you that in the short term, the breadth conditions are less than ideal. And then the final kicker, and this is what has prevented a completed Hindenburg Omen signal in these other 4 times when we've sort of sounded the initial alarm, but have said, you know what, we ran out of time to confirm it. You need multiple existences or multiple confirmations of these 3 criteria being met on the same day, and you need it multiple times within 1 month. And that was what he found, was basically there would be a period. Tops were not a moment. Tops were a process. You need this to happen a couple times. And when that happens, it's usually not great. When I do a video, I'll dive a little deeper into some of the history, but I will show you on this chart the last 2 times that confirmed Hindenburg Omen has happened was in December 21, just before that exciting 2022 happened. And then literally just before the COVID peak, or going into the COVID peak in February of 2020, we had a Hindenburg Omen as well. If you look back, major peaks have often had this Hindenburg Omen fire. When people are critical of this particular indicator, it's because it fires too often. People joke it's called, 10 of the last 4 recessions or something like that, or 10 of the last 4 corrections. And I get it. Sometimes it'll do a false positive, right? Where it'll signal, and then the market doesn't actually fall down. And that's why I will tell you, what I have learned is when the Hindenburg Omen fires, that tells me to be on red alert for signs of distribution, particularly with stocks breaking down, with indexes breaking down, really focusing on, especially now where the markets are still in a position of strength, focus on what you would need to see to take profits. Focus on where something would need to go for you to unwind some sort of long position, and just keep those updated now while things overall in terms of the indexes are still pretty good. So that is what the Hindenburg Omen is. That is what it means that we finally had a signal. And if you remember me mentioning that, I did every time this thing popped up. We just haven't had the confirmed signal. And now we have, it's been 3 years since we've had one. The last time basically meant the next 9 to 10 months were not going up, as we can see. And what concerns me is last time this happened was really after that bullish 21, which is, so similar from a technical perspective to what 2024 has been. So I'm concerned about conditions going into the beginning of next year for sure. Now, here's the thing. One of the ways that, or the reasons why the Hindenburg Omen has fired, the reason why I think there should be cause for concern is because, as someone mentioned in the question, something I've cited before, right? You have the generals and then you have the infantry, right? You have the generals, the FANG names, the NVIDIA, Apple, Alphabet kind of stocks, and then you have the infantry, sort of the random names that comprise the market and are not the big mega cap growth stocks. I would argue if you ignore the generals and just look at the infantry, things are not particularly strong at the moment. As a matter of fact, December has actually been pretty rough. Here's the S&P holding steady around 60.50. Here's the advanced decline line on the New York Stock Exchange, clearly trending lower from Thanksgiving. Here's the percent of stocks above their 50-day moving average, which were around 70% at Thanksgiving, and today just dipped below 40%. So about a third of the S&P members have broken their 50-day moving average in the month of December, right? Think about that, right? So while NVIDIA is still kind of breaking down, but still not bad, Meta and Alphabet and Tesla are just making new highs and looking like things are great. A lot of stocks are actually breaking down through their 50-day moving average, which is not great. The bullish percent index has come down quite a bit. And as we highlighted, I think on yesterday's show, it's a bit of a blur. Actually, this was for my show on Stock Charts TV. Yesterday, I talked a little bit about the bullish percent index on the S&P 500 versus the Nasdaq. The Nasdaq's bullish percent index still hanging around 70%, and the S&P's bullish percent index kind of going into a free fall. So what these measures mean is basically the market is holding up because of the generals that are still okay, those mega cap growth names, but a lot of other things are breaking down. And what often will happen is if people are in the relative safety of they're hiding out in the big mega cap growth names, once we start taking profits on those, what's going to happen next? And usually what would happen, I think what would happen, we'll see, is either, investors rotate to pure defensive positionings, like utilities and real estate and consumer staples, like higher yielding names, low beta names, right? If you go to like a low vol ETF, would start to do really, really well when it hasn't in recent months. Or out of equities and into like bonds, right? And all of a sudden you see bonds start to rally and it's more of a safety trade and things like that. That's what happened in 2022, right? The dollar spiked and everything else started coming down. So again, I think as always, you want to be watching the trends, but these signs here suggest to me that there's a lot more deterioration to be concerned about going into the end of next year. The VIX is starting to push higher. I don't think to the degree that it's like, all right, this is a real problem. I mean, the last time we did that was, back in Q3, right? In July, August, we spiked aggressively higher on the VIX. And a number of reasons why I think that happened. And if you missed my podcast interview with Russell Rhodes, just knows the VIX backwards and forwards and has been teaching traders about it for many, many years. Go back to that conversation. He talked in particular about that spike and how to make sense of it. I thought his answer was better than anything I've come up with. But I would say the VIX is just starting to spike higher. Finished today right around 16. And I would say a spike in the VIX, when I've talked to a bunch of people that I know and respect in recent weeks, what's the warning sign you're looking for? Most of them mentioned a spike in volatility. So this is a good chart to watch to see if you see additional push higher in the VIX. If we do get above 16, if we get above 20, again, no guarantee that that's the end of the world. That actually happened back here in Q3 and we recovered okay. But if you look back, you'll find a lot of times where we spike above 20, and that's just the beginning of a distribution period. So the VIX for now starting to pop higher a little bit. All right, couple individual stocks to watch. I mean, boy, I didn't have to look that hard to find a chart that still looks pretty good. And this is just a friendly reminder that even though I'm mentioning all of these concerns about breadth, concerns about volatility, concerns about the major averages, charts like Visa are still out there, right? There are still charts that look really good. And I think that's something to remember in any bear market cycle I've ever been involved with. There have been winners. There have been stocks that actually do quite well. And whether they look as beautiful on an absolute basis as Visa, I don't know. But there are things that are definitely going to outperform. And I would say in this type of environment, you really want to focus on the relative performance, focus on things that are outperforming, particularly in down tape. Those can be defensive positionings to help you ride out periods of market uncertainty. And if you're worried about the market going lower, there are plenty of tools you have available to you now, plenty of levers you can pull using the options market, using leveraged ETFs, using inverse ETFs, et cetera, et cetera. So I would, and even just going to defensive, higher yielding positions and at least starting to allocate a little bit toward defensive positioning. Again, I'm not seeing the breakdowns yet to completely justify a full defensive positioning, but I'm seeing enough warning signs to think about it. But a chart like Visa, it doesn't really matter to me what the market as a whole is doing. I'm probably always going to be happy owning a chart like that because it's going up and it's not going down. Now, a lot of things are not going up right now, to be clear. And I think NVIDIA is one of those examples. We talked about the level of 132 as being the lower end of this range that we've been in. A breakdown below 132, which really happened on an intraday basis on Monday, but happened on a closing basis today, completes that breakdown. The volume has not been particularly good. The momentum has been relatively weak, but the price has held up. But in the last week or two, we've broken below the 50-day moving average. We're now breaking to a new swing low. So we're now making lower highs and lower lows. So NVIDIA, based on that simple definition, not really in a short-term uptrend anymore. I would say in the short term, it's actually in a downtrend now. The question is the longer-term trend. The weekly chart's still fine, right? We're still overall in a larger uptrend, and that's where I would be watching like the 200-day moving average. What's interesting is if you take the height of this pattern on NVIDIA, project that from that support level, that actually gives you a downside level right around 115 to 116, right to the 200-day moving average. Maybe that is the next move. But again, I think the breakdown suggests to me probably a better buying point is going to come soon. I don't know if we've necessarily seen the low here just yet. T-Mobile actually breaking down. We've highlighted this one because it's been one of the better charts earlier in the year. And again, through Thanksgiving, I mean, just a fantastic chart of higher highs and higher lows. But look how all of that has changed. We had a big distribution day about 2 weeks ago. We had another big distribution day today, down about 4%. That takes us below the 50-day moving average. Really for the first time since March, April. We did briefly go below there in July, but last time we really spent any time below there was back there. The RSI has now broken below 40. So for me, that's kind of enough where I would say, all right, if I do have a position in T-Mobile, which I actually do not, but if I did, this is where I would probably be lightening up, because we've broken down enough that there's a possibility this is just the beginning. And when you have a chart like this, while the chart is still okay, right? We're not that far off of all-time highs. We've come down enough that the chances are greater that this is the beginning of a multi-leg move downwards. And I just want to avoid that, right? I think one of the ways you survive and thrive as an investor is get out of the way of things that are not going up anymore. Get out of the ways of things that are really deteriorating your portfolio value. This could be one that is just starting to do that. I would be using things like Fibonacci retracements and others to identify some downside targets, but for now, not going up anymore. Now, when you do have a chart going down, I want to highlight Southern, which is in the utility sector, flashing a bullish engulfing pattern today. And that's when you have a 2-candle pattern, a down day and an up day. Day 2's candle engulfs the body of day 1's candle. So that's actually a short-term reversal signal suggesting that this downtrend is probably going to reverse here. And what's interesting is that's happening right at a 38.2% retracement of the February to October rally, which means it's happening in an interesting place and also just above the 200-day moving average, right as we're coming out of that oversold territory. So when we do have a chart like NVIDIA or like T-Mobile that starts to go down, I immediately start looking for, are there any constructive candle patterns, for example, that could tell me that there's a bit of a bounce starting to emerge. I think we might be seeing that today on the chart of Southern. All right, I do want to take a couple questions. I did get a number of questions here on a bunch of different things. So let me get to a couple of these. And thanks so much, all of you watching on all the different platforms. All right, Bull Bear Jeff on YouTube asking, hey, David, on the market overview page, how come it doesn't have the Russell 200 as a separate row? I'm guessing probably in the Russell 2000, the small cap index. Great question. I think you're talking about this. Again, I'm not at stock charts full time at this point. I lost the battle of putting the Russell in here somewhere. And to be honest with you, I think it goes to just data, places where stock charts and other platforms get data from. You have to feature whatever data you actually can get in a good way. The Russell, I know the Russell indexes, right? Like the Russell 2000 index, you actually can't access on stock charts anymore, but you can use the Russell 2000 ETF, ticker IWM, and that's what I use, and it tracks almost perfectly the index, so it's pretty much fine. But that's the only reason. When I'm charting the small cap space, I almost always use the IWM, use the Russell 2000. This is here just as a quick, market update on what's moving. I would always encourage you to dig deeper beyond those major averages. Things like transports, right, aren't on the front, but arguably those could be interesting to watch as well. So this is just a starting point. I think, as opposed to having things featured, what's happening is I know Stock Charts is working on allowing you to customize your dashboard. And so I think instead of making big changes to this front page, which is a lot more work than you'd think, allowing people to create their own dashboards with their own watch list and track whatever tickers you want makes a lot of sense. It's not done yet, but eventually you'll be able to click on dashboards and should be able to create your own custom dashboard. These are some example ones that they've been testing. So hopefully that happens soon, because I'd love to put the Russell 2000 on my own dashboard as well. 100% agree. We are on the same page, my friend. All right. What else? Is the Santa Claus rally still possible? John, you asked on YouTube. Yeah. So what you have to remember is things like the Santa Claus rally, things like the January effect, they've kind of taken on lives of their own. But the Santa Claus rally really just deals with the end of December and sort of that traditional kind of rally phase that happens, sort of between Christmas and New Year's, if I remember right. I probably should talk with Jeff Hirsch, who's sort of the keeper of all things seasonality, an editor of the Stock Traders Almanac. I am due to get him back on the podcast, and I will make a point of asking him that when I do. So 100% sure. And I would say, to be honest with you, I wouldn't be surprised. We'll see what happens tomorrow, right? With the Fed meeting, that's still a bit of an unknown. But I would say between the Fed meeting, once that's wrapped, there's not a lot else between now and, the beginning of January. So usually you get sort of that rally phase in at the end of the year. Most likely, given the strength that you've seen from all the Magnificent Seven names, I wouldn't be surprised if like NVIDIA names They're starting to pull back a little bit. Wouldn't be surprised if they pop higher, because if you're a money manager and you're benchmarked to the S&P 500, there's the quarter end window dressing, or the annual window dressing, which is basically you've probably made some random weird bets that may not exactly fit into your mandate as a for your fund. But you have some wiggle room to do that during the quarter. But at the end of the quarter, there's a quarterly snapshot of your holdings. So there's a window dressing that tends to happen where fund managers will kind of unwind those crazy positions that they don't want to have any questions about when they're meeting their big institutional clients in the new year. And so they go back to sort of they want to show that they've been in the best places. So they're going to rotate into some of those winning names. So I wouldn't be surprised if the Magnificent Seven stocks do pretty well through the remainder of the year. The real question is going to be the beginning of January, which is when those positions can be unwound, when things can go different places. That's when I wouldn't be surprised if like mega caps pull back, small caps thrive, non-growth sectors start to improve. All of those things are certainly a possibility, but most likely that doesn't happen until the beginning of next year, because of that sort of quarter end period. The Santa Claus rally, I would say, is all sort of part of that thing. Let's see. One final question. Kip asking on YouTube, Dave, FX has been weak against the dollar for some time now, especially the Canadian loonie and the Australian dollar. Do you see the US dollar losing some strength anytime soon here? You know, I don't look at, I don't bring currencies up on the show too often, and maybe that's something I could improve on for next year. But I would generally say, I kind of agree with what you're saying. The dollar overall has been pretty strong, right? Coming off of, Q4 has actually been pretty good. The dollar is kind of pushing above that 107 level, and back over the last, year or two, we've talked a number of times about if the dollar gets above 107, that could be breaking out a bit. If you look at the weekly chart of the dollar, this is the potential problem here, right? Is if you have the dollar kind of sideways and then all of a sudden breaking out and the dollar strengthens versus other currencies. Last time you had a real strong period of dollar strengthening was actually coming out of 2021. It really happened kind of late 21 into the beginning of 22. And then 2022 was a strong dollar and then weak pretty much everything else, right? Everything was going down, but the dollar essentially. And it was a really sort of unusual year coming after 21 when so many things were doing well. That was sort of the, glory days of the liquidity driven COVID rally. But I would say, the dollar is certainly testing upside resistance. I wouldn't be surprised if we break further from there. That basically tells me, non-US stocks have not been a great bet. I was looking earlier at the performance of a bunch of global ETFs versus the S&P, and almost nothing has outperformed the S&P in terms of the major markets that I would track. So it's been the US over non-US just because of the leadership themes, but that could very much change in the new year. It could be very, very different. And I think that's what I'm sort of bracing for mentally, which I hope you are as well, is 21 into 22 was a very, just a dramatically different year in so many ways from a technical perspective. Things that were going up, like the S&P, literally right up into the end of December, and then all started to go down. And I'm mentally preparing myself for a similar experience at the beginning of 25. The good news is the charts usually tell you when that's happening, right? And so the best recommendation I can give all of you is keep watching the charts and focus on evidence that this bull market may be starting to change. That's it for the day, folks. Thank you guys so much for tuning in. Those of you that are on the live stream, thanks for all the great questions. I only got to a handful of the ones that I saw. I'll put all the ones I didn't get to into the mailbag, and I'll hope to answer one of yours in our all mailbag episode at the end of the week. But thanks so much for tuning in here today. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Have a good one.